So you want to get started with this whole investing thing, right? You heard on the news if you had bought Amazon or Tesla 5 years ago, 10 years ago, you'd be a millionaire today. Well, that may be true, but if you're new to this whole investing thing, then it can all be a bit overwhelming and you might not even know where to start. And beyond that, people are throwing around a whole bunch of letters and numbers like Roth IRA and 401k, and what do all those things mean? And then there's that anxiety that you could ultimately lose all your investments if you make some bad choices. Well, take a deep breath. Relax. All right, let me do some of the heavy lifting here and clear up some of these issues. So if that's what you're here for, then go ahead and smash that like button and let's get started. Now, in terms of investing, there's a few things that you need to get out of the way before you actually put any money into investments, and that's so that you make sure you're making good, smart financial choices and protecting yourself. So how do you defend your investments? Step one is create an emergency fund. An emergency is basically a stash of cash in a high yield savings account set aside so that if anything happens in your life, you're not actually having to sell the investments to pay for the emergencies. Let's just say you were to lose your job because the economy's not doing so well. Well, if at the same time you lost your job and needed to use an emergency fund, you had to sell your investments to get the emergency fund, well, odds are your investments have lost value as well because the economy has turned around. So you're gonna have to withdraw money at a point where your investments have lost value. That's called selling low. You know, they say buy low and sell high. Well, if you're in the middle of an economic downturn, you're likely selling low, which is the exact opposite of how you maximize your investments. So that's the importance of the emergency fund before you invest so that you can protect your investments in the case of an emergency. Now, once you got that emergency fund set up to protect your investments, again, before you actually get to the point where you put money into investments, you got to think about debt. Now, eliminating debt is going to be a big step in preparing for your investments because if you have high interest debt like credit card debt, then the amount of money that you are losing to the interest on your debt is much higher than the amount that you would be gaining by putting your money into most investments. You want to get the debt out of your life so that you can put money into the investments and have that investment growth outpace any other expenses or fees you may be paying. If you're losing, 15, 20% to interest rates on a credit card, then if you make even high returns of say 10 to 12% over the long haul, that's not going to outpace the interest you're paying. So pay off the interest, get the debt out of your life, then move on to the investment steps. So once you've got your emergency fund set up and you've decided to eliminate the debt that you need to get out of your life, then we move on to what I call your exit strategy. And go ahead and smash that like button. I call it your exit strategy because this is where your investments help to get you out of the workforce and into the financial freedom force. How are you going to invest? How are you going to build your nest egg? How are you going to get out of the workforce? Without that strategy, your investments are going to be all over the place and be inefficient overall. And once you hit that sort of financial freedom amount in your investments, it doesn't mean you have to quit working entirely. It just gives you the freedom to now choose how you work and when you work and where you work, all right? You might still want to work part-time doing something. You might want to take extended vacations. You might want to work for yourself, run your own little business. You can do whatever you want because now you're not reliant on a paycheck to pay your bills. Your investments have taken that place. So how do we get there? Well, the first thing that you're going to want to do is to look into retirement accounts. Even if you plan to retire early, it's a good idea to put money into retirement accounts because of the tax benefits. For most people, taxes will be one of the biggest expenses you pay your entire life. So why not take advantage of all opportunities to minimize that tax burden? So if you're an employee working for a company, you likely have the opportunity to invest in what is called a 401k. Now, if you work for a nonprofit, the same principles surround what's called a 403b. It's just a different set of numbers and letters. It's the same type of tax advantage account. So with a 401k or 403b, basically you're taking money out of your paycheck before you paid any taxes on it, and you're putting that into this account. The 401k is not the investment itself. You still have to choose which stocks and mutual funds and index funds to invest within the 401k, but the 401k account is what protects you from the tax liability. So you put the money in there before you pay taxes on it, which lowers how much you have to pay taxes this year on your income, because basically you're putting that money aside and it's as though you never earned it. It doesn't count against you as earned income for this year. The downside to this deferred tax is that you do pay taxes on this when you're retired, when you're actually withdrawing the money or selling the investments in order to live in your retirement age. So you get the tax benefit today, but you pay taxes later. And another huge benefit for 401k or 403b is company match. A company match is basically free money. So if a company has a 3% match, then if you contribute up to 3% of what your earned income is, they will put that same 3% in. So for easy math, let's just say you made $100,000 a year. Well, 3% of that $100,000 is $3,000. So if you put $3,000 into your 401k, your company's gonna match that $3,000 and give you $3,000 for free, and the $3,000 they gave you is also going to grow and compound over time. So they didn't really just give you $3,000, they gave you $3,000 times the number of years you have to wait and the growth that's going to come from that. So it's a huge benefit of taking advantage of a company match. So if your company offers a match, always 100% of the time contribute up to the max. So what do you do after you've got the company match and after you've got your 401k set out? Well, after you reach the amount where you've paid up to the amount where you're getting a match, which is the free money from your company, then I recommend opening a Roth IRA. Now, what's a Roth IRA? Well, the Roth part of it also means you're tax advantaged. But the difference between the Roth in the IRA versus a traditional IRA is a traditional IRA is just like the 401k. You don't pay taxes now, but you do have to pay taxes in the future. A Roth IRA is money that you're using to invest after you've already paid your income taxes. So you pay the income taxes on your income, you take money from your bank, and you put it into a Roth IRA account, and now that money grows tax-free, so when you retire, you don't pay anything, zero in taxes in retirement on your money from a Roth IRA. So it is a huge benefit to be able to put money into a Roth IRA. Definitely use the Roth IRA after you've benefited from the match from your company. Now, another question is, how much do I invest for my retirement? Well, this is a never-ending debate, and some people say less, some people say more. Ultimately, as much as you can stand to put aside and not have to worry about paying your bills and things, I would try to maximize that amount that you can live without, because all that's going to do is mean that you can retire sooner. But I don't want that to be a barrier to beginning. So again, if you're starting out with investing, just figure out what you can put away, but do it every single month. If it's just $5 this month, do $5. If it's $20, do $20. But you want to kind of keep increasing that amount over time. And ideally, you want to get up to 10, 15, 20% of your income is what you're putting away. But you might not be at a place where you can start doing that today, so start with what you can. Now, how do you figure out what that top end is of what you actually need to be putting aside to be able to retire the way that you want? You can use something called the 4% rule or the 25 times rule. And basically what this means is that you're going to figure out how much annually do I want to be spending in retirement. So if you make $50,000 a year and you're happy with your lifestyle at that amount, then you would take $50,000 and you would multiply that by 25. If you want to be able to spend $100,000 a year in your retirement, then you're going to take that $100,000 and multiply that by 25. And that's going to give you a large number. Now, I want you to also remember, this is kind of a more advanced idea, but this isn't going to take into account inflation. $50,000 today is not going to pay for what $50,000 later is going to pay for. You're going to need more money. So there's a tool that's called the RIQ. It was made by Chris Hogan here, and you can find it by just going to Google and type in Chris Hogan RIQ. So now that you've used the RIQ tool and you know how much monthly you need to try to be achieving in order to reach your retirement goals, then that helps you figure out, all right, if I can only put away $10 a month now or $100 a month now or whatever, but I'm trying to reach putting away $500 a month or $700 a month or $1,000 or whatever you figured out that is going to be your retirement plan. After you have that figured out and you've reached that point, now you can either just put more money in that account, which means you'll have more money to spend in retirement, or you can start to invest outside of a retirement account. Now, why would you invest outside of a retirement account? Well, those 401ks and those Roth IRAs have a limit to the age that you can start withdrawing from. So 59.5 is the age at which you can start to withdraw money from those accounts without paying taxes or penalties. So if you plan to retire or would like to retire before 59.5, then you need to have money in an account that's available to you that you can use without having to pay fees before that age. If you know that you've fully funded the retirement accounts so that at 59.5, you know from 59.5 until you die, your retirement is taken care of. Everything beyond that now is to make sure that you have money to live on before you get to 59.5 if you choose to retire then. But how do you invest in accounts outside of retirement accounts? this is where things can really open up and you can smash that like button. This is often referred to as financial independence or financial freedom. Remember, I talked about your exit strategy is so that you could exit the workforce and enter the financial freedom force. All right, this is that opportunity to do so even before that age of 59 and a half. And the stock market is still a great place to do this, just like you were doing it for your retirement accounts in your 401k or your Roth IRA. You can actually utilize the exact same strategy of putting money into those accounts by using index funds or ETFs. Not all stocks are created equal, and so if you do just buy individual company stocks, which is what a lot of people will recommend, if any of those individual stocks does really poorly, you lose a lot of money. Conversely, if they do really well, you've made a lot of money. But being able to pick the right stocks at the right times is a very challenging and full-time and even beyond some full-time people's ability. In fact, Warren Buffett made a bet with hedge fund managers that the S&P 500 index would outperform their investments over a 10-year period. And guess who won? The S&P 500. It outperformed hedge fund managers. Now, they did outperform the S&P 500 at the beginning while they picked certain stocks, but over the course of the long term, that 10-year period, they couldn't pick the right stocks to beat the market consistently over the long term. That's why an index fund is a better way to go for long-term investing. Now, to clarify, I am not a financial advisor and I'm not a tax professional. If you have any questions related to those things, you can find a professional to help you with. And again, this perspective is for somebody who is younger and starting their investment journey. If you're somebody who is within 3 to 5 years of retirement, then you're going to want to have some more conservative investments and not maybe so aggressive in terms of having as much in stocks. And in case you were wondering why I recommend index funds specifically as compared to mutual funds, the basic difference is that the fee structure of a mutual fund that's managed is higher than the fees of an index fund that is passive. And index funds compared to individual stocks is a much lower risk compared to individual stocks. So having that peace of mind that you can go to bed at night and not worry whether or not your individual company did better or worse today, that peace of mind and that ability to not have the anxiety, that matters a lot in retirement as well. I definitely recommend lowering your risk through index funds and lowering your fees from mutual funds. This strategy has made a lot of people wealthy over the years, so you can too.